You might be hearing whispers about some potential uh, big shifts in the housing market.
Mm,
And a lot of it seems to center around two names you've probably heard, Fannie Mae and Freddie Mac.
right. The GSEs.
Exactly.
Yeah.
Apparently, there are rumblings, maybe the Trump administration revisiting plans to privatize them.
Yeah, that's definitely been part of the conversation again.
So the big question is, what does that even mean for us, for the average person?
Uh-huh.
Could it actually impact mortgage rates or maybe even housing prices?
That's precisely the crucial question we're tackling today. It can seem a bit tangled, this whole area,
That sounds complicated.
but our mission here is really to unpack what these potential changes involve, why they're significant.
And what the source materials suggest the impact could be, right,
Mm.
on housing costs and those all-important mortgage
Yes,
rates.
we'll break it down, make it understandable.
Okay, good. So let's maybe start at the very beginning. Like, before Fannie and Freddie even existed,
Hmm.
what was it like trying to buy a home?
Oh, way back, say in the 1930s, it was a completely different world.
How so?
The source material highlights you often needed a massive down payment, like 50%.
15%? Yeah.
Think about that. And even if you somehow had that kind of cash, just getting a loan was incredibly difficult.
Especially during the Great Depression, I imagine.
Absolutely. Banks were, understandably very hesitant. Too much risk.
50%.
Mm.
That's almost unimaginable today. So how did Fannie Mae first come into the picture then to fix this?
Well, in 1938, the U.S. government created Fannie Mae, that's the Federal National Mortgage Association.
Yep.
The core idea was simple: make mortgages more accessible to more Americans. Get the housing market moving.
And was it always private?
No, that's interesting. It started as a government agency, but then it was actually privatized back in 1968.
Huh. Why then?
Well, the thinking at the time was sort of that the initial goal, making mortgages more available, had largely been achieved through this government program.
Okay, so Fannie was around making things easier, but then Freddie Mac shows up in 1970. Why create a second one?
Right. So even after Fannie's privatization, there was still this feeling that a segment of the population, maybe lower incomes particularly, needed more support.
Still struggling to get mortgages.
Yeah. So in 1970, the government established Freddie Mac, the Federal Home Loan Mortgage Corporation.
Ah,
The specific aim was to further help those individuals. And like Fannie, Freddie also eventually went private in 1989.
now here's a point I think a lot of people might get wrong. Fannie and Freddie, they don't actually give you the mortgage, do they? Like, you don't go to a Fannie Mae office for a loan.
Exactly. No, that's a crucial distinction. They don't originate loans.
So what do they do?
What they do is they buy mortgages from the lenders, the local bank credit unions.
Okay, they buy the loans after the bank makes them.
Correct. Then they take these individual mortgages, bundle them together, lots of them, into what are called mortgage-backed securities, MBS, basically packages of mortgages.
Right. And then,
And then they sell these packages, these securities, to investors on the open market.
okay, let's use that analogy you mentioned, the chef one. That might help clarify this.
Sure. So think of a bank like a chef, okay? Cooking up all these individual meals. Those are the mortgages.
Right, one mortgage, one meal.
Exactly. Now, instead of that chef waiting, say, 30 years for each customer to slowly pay for their meal.
Which ties up the chef's money and time.
Right. The chef decides to sell collections of these meal tickets, basically the rights to the future payments on those meals or mortgages.
Okay, so the meal tickets are the mortgages. Who buys them?
That's where Fannie and Freddie come in. They're like a big catering company.
Ah, the catering company.
They come along and buy up these bundles of meal tickets, the mortgage-backed securities from the chefs, the banks.
And why does the bank, the chef, do that?
It gives the banks a big chunk of capital right away, cash up front, instead of having their money tied up for decades in individual loans.
Got it. So the bank gets paid quickly. Then what does the catering company, Fannie and Freddie, do with these bundles of meal tickets?
They then sell shares or pieces of these collections to like big event organizers.
Who are the event organizers in this scenario?
They represent the large investors, pension funds, insurance companies, global investors, people looking for relatively stable income from those mortgage payments.
Okay, so the investors buy pieces of these mortgage bundles from Fannie and Freddie.
Yes, and this whole process, this flow, it allows the chefs, the banks to get capital quickly so they can make more loans.
Keep cooking more meals.
Exactly. And it helps keep the cost of those individual meals, the interest rates on mortgages, more reasonable for you, the home buyer.
That analogy really helps visualize it. Okay, so why is this system, this whole Fannie and Freddie setup, so important? What difference does it really make?
Well, fundamentally, they are key, absolutely key, to making those long-term 30-year mortgages with relatively low interest rates possible in the U.S.
The standard 30-year fixed.
That's the one. Think about it from the bank's perspective again. Our source mentioned an example. A $1 million 30-year mortgage at, let's say, 5% interest.
Yeah.
For a regular bank to just hold on to that single loan for 3 decades, that ties up a huge amount of their capital for a very, very long time.
And it's risky, right? What if the borrower stops paying 15 years in?
Precisely. There's always that default risk. But when Fannie and Freddie bundle that mortgage with thousands of others,
It spreads the risk out.
exactly, it significantly reduces the risk for the end investors. Even if one homeowner or a few default, the vast majority are likely still making payments.
So investors feel safer buying these bundles.
Much safer.
Yeah.
And because the risk is perceived as lower, thanks to this bundling and, importantly, the implicit government backing we'll talk about,
Yeah.
investors are willing to accept a lower rate of return on their investment.
And that translates into lower mortgage interest rates for borrowers.
Directly. That's the mechanism. Plus, it provides massive liquidity, basically readily available cash to the mortgage market. Banks know they can sell these loans, so they keep lending.
And the scale is huge.
Immense. The source mentions they have a combined market share of around 70% of the U.S. mortgage market.
70%.
Yeah, providing nearly $1 trillion in liquidity. That's a T.
Wow. That's staggering.
It is. And it's also worth noting, generally, Fannie Mae tends to focus a bit more on larger mortgages, while Freddie Mac traditionally leans towards smaller ones.
Okay, so this system seems pretty vital for keeping mortgages flowing and rates reasonable. But then, 2008 happened, the crash. What role did Fannie and Freddie play there?
Yeah, well, unfortunately, they played a significant role, a central one, really.
How so?
The source material explains that in the years leading up to the crisis, Fannie and Freddie started buying much riskier mortgages, specifically those infamous subprime mortgages.
Subprime. We heard that term a lot. What made them so risky?
These were essentially low-quality loans. In hindsight, many probably shouldn't have been issued at all.
Given to people who couldn't really afford them.
Often, yes. Borrowers with poor credit histories, maybe unstable income, documentation was sometimes lacking. High risk of default baked in.
But Fannie and Freddie were buying these shaky loans anyway.
They were, and bundling them into mortgage-backed securities, just like the good ones, sometimes mixing them in.
Okay, I see where this is going. What happened when those borrowers inevitably started defaulting?
That's when the dominoes really started to fall. As more and more subprime mortgages went bad, the value of those mortgage-backed securities plummeted.
Bundles became toxic.
Exactly. Investors suddenly realized the huge level of risk they'd actually taken on, often without fully understanding it, and they panicked.
Stopped buying. Stopped lending.
Pretty much. Credit markets froze. Lending dried up. Investing stopped. It triggered that widespread financial collapse.
But Fannie and Freddie themselves, they must have been holding a lot of this bad debt.
Absolutely. They were heavily impacted.
Hmm.
Because they owned or guaranteed so many of these now toxic assets, they suffered massive, massive losses.
How much are we talking?
The source notes they lost over $300 billion just between 2008 and 2011.
$300 billion.
Yes. As housing prices kept falling, the losses mounted. It reached a point where they were insolvent.
So what happened?
The U.S. government had to step in, a massive bailout. They essentially took control of both companies through a process called conservatorship or receivership.
Basically, a government takeover to prevent total collapse.
That was the rationale, yes, to stabilize the financial system and prevent an even bigger catastrophe.
Was that taxpayer money used for the bailout?
Initially, yes, it was a huge injection of public funds.
Did they ever pay it back?
Yes, that's an important point the source makes. By 2019, both Fannie and Freddie had actually repaid the full amount of the bailout money, plus dividends.
Okay, so they're sort of back on their feet, financially speaking.
Well, they started retaining their profits after that, building up capital reserves, which, as we'll get to, is directly relevant to this whole privatization discussion.
Right. So let's fast forward. The Trump administration's reported interest now in privatizing them again. Why the push? What's the argument for changing things up after all that?
Well, there are different perspectives, as you'd expect. The source highlights that critics worry privatization could just be a way for insiders or certain investors to profit maybe through stock manipulation.
Okay, that's the critical view. What about the proponents?
Proponents argue that the current situation, with the government in de facto control, has made mortgages artificially cheap.
How so?
Because everyone assumes the government will step in again if things go bad, that implicit guarantee. This removes true market risk for investors.
So the argument is this encourages too much risk-taking, potentially inflating prices, like another bubble.
That's a core part of the argument, yes. That it contributes to housing bubbles by shielding investors and keeping rates lower than a purely private market would allow.
It's like a safety net that maybe shouldn't be there, according to them.
Precisely. The idea is that this government backing creates a duopoly. Fannie and Freddie dominate the market and keeps rates artificially low. Great for borrowers in the short term, maybe, but potentially destabilizing for the market overall.
Okay, so let's game this out. If they were privatized, what would be the immediate impact, according to the source?
In the short term, the most likely immediate impact: an increase in mortgage rates.
Because that government safety net is gone.
Exactly. Without that implicit backing, investors would demand a higher return to compensate for taking on more actual risk. Higher return means higher rates for borrowers.
And what about house prices? Would they drop right away?
Interestingly, the source suggests maybe not immediately. You could have this awkward period where mortgage rates go up, but housing prices stay high, at least initially.
Ouch. That makes affordability even worse.
It definitely could, yeah. That's a major concern in the short-term transition.
Okay, what about the longer-term consequences then? If privatization sticks?
Over the longer run, the expectation is that those higher mortgage rates would eventually dampen demand for housing.
Leading to falling prices.
Potentially, yes.
Yeah.
Which would be, good news for people trying to buy a home, but maybe not so great for current homeowners who could see their property values decrease.
A double-edged sword there.
For sure.
Yeah.
And another thing, without that government guarantee, Fannie and Freddie themselves might actually lose market share. Other private companies might be better able to compete.
Okay, let's try that other metaphor, the swimming pool one. How does that fit in here?
Right. So imagine the current housing market with Fannie and Freddie as they are now is like a swimming pool.
Okay.
But the water level, think of that as the interest rates is kept artificially low, lower than it naturally would be,
Oh.
by these government pumps representing the implicit guarantee and their market dominance. They're constantly pumping to keep that water level down.
Got it. So privatization is...
Privatization would be like turning off those government pumps.
What happens then?
The water level interest rates would naturally rise to reflect the actual market conditions, the real level of risk.
Mm-hmm.
And as that water level rises, it might reveal rocks at the bottom of the pool.
Rocks being.
Unsustainable housing prices. Prices that only looked okay because the water level, the interest rates, was kept artificially low.
That's a really clear picture. Okay, so the Trump administration tried this in 2019, you said, but it failed. Congressional hurdles were mentioned. How might they try it this time, if they pursue it?
The thinking, based on the source, is they might try to rely more on the executive branch this time, bypass some of the legislative roadblocks.
Like which parts of the executive branch?
Specifically, the Federal Housing Finance Agency, the FHFA, that's the regulator that oversees Fannie and Freddie,
Okay.
and also the Treasury Department, which plays a key role in any government guarantees.
And isn't there a new director at the FHFA?
Yes, William is his name. The source describes him as having a business background buying, building, selling companies.
Any signs of his intentions?
Well, his initial actions reportedly included some cost-cutting and shaking up the boards at Fannie and Freddie. Signs of change, perhaps.
But does that mean privatization is imminent?
Not necessarily. He's also quoted as saying privatization isn't an immediate priority, that it depends on assessing the impact on the mortgage market first. So it's not a clear signal yet.
Okay, watch this space, kind of. What about the Treasury Secretary, Scott Bessent? Any clues there?
He hasn't said a whole lot publicly on this specific topic. There was some mention of Trump's proposed sovereign wealth fund potentially investing in Fannie and Freddie.
Which sounds like a step towards privatization.
Some interpreted it that way, but the source suggests it's not quite that simple. Experts like Chris Wen argue that, realistically, for any smooth transition, some kind of government guarantee from the Treasury would likely still be needed.
Even if they're privately owned. Why?
To avoid massive disruption in the mortgage markets, investors have become so accustomed to that safety net. Women believes they'd probably still expect some kind of backstop, given the history.
That makes sense. Investors crave stability, especially after 2008. And didn't the source also mention a link between their credit rating and the U.S. government's?
Yes, that's another important connection. Because they're so intertwined, if the U.S. government's credit rating were ever downgraded, maybe due to debt ceiling fights or something, that could negatively impact Fannie and Freddie's credit rating too, even if they were technically private, which would increase their borrowing costs.
So they're never fully detached, in a way. Now, a really key point from the source seemed to be that this whole privatization thing is likely a long way off regardless of intentions. Why?
The main reason boils down to money, capital reserves.
They need to save up.
A lot. The Congressional Budget Office, the CBO, estimated they might need somewhere between roughly $267 billion and $534 billion in capital reserve.
Billion. That's a huge range, but both ends are massive numbers.
Exactly, to be able to operate safely as private entities without causing market panic.
And where are they now? How much do they have?
Currently, their reserves are estimated to be around $150 billion.
Okay, so still a significant shortfall.
Right, and they're growing those reserves, retaining profits at a rate of about $20 to $25 billion per year.
So if you do the math,
You're looking at anywhere from another 5 years on the very optimistic side to maybe 10, even 15 years before they hit those kinds of capital levels needed for privatization.
wow. So 5 to 15 years, that's a much longer timeline than you might think hearing the headlines.
It really puts it in perspective. Even if the political will is there tomorrow, the financial reality means it's likely a slow, gradual process at best.
Okay, so if Fannie and Freddie's status isn't changing dramatically anytime soon, what other factors could impact the housing market in the meantime? Things happening regardless of privatization.
Oh, there are several big ones. First, as we sort of touched on, the U.S. government's own credit rating.
Debt ceiling debates and potential downgrade.
Exactly. If the U.S. gets downgraded by rating agencies, it generally pushes up borrowing costs for the government.
And that ripples through the economy.
It can, yeah. It could lead to slightly higher interest rates across the board, and that often includes mortgage rates. Because U.S. Treasury bonds are like a benchmark.
So higher government borrowing costs could mean higher mortgage costs for individuals.
It's a potential knock-on effect, yes.
What else?
The other really big one is just overall U.S. interest rates, especially long-term rates.
It's set by the Federal Reserve.
Well, the Fed directly controls short-term rates, but long-term rates, like those on 30-year mortgages, are more influenced by the market's expectation of future inflation, economic growth, and importantly, the yield on 10-year U.S. government bonds.
The 10-year Treasury yield. Okay, what drives that?
A bunch of things, according to the source.
Yeah.
Fed policy is one, expectations about economic growth, inflation forecasts are huge, and also the sheer amount of government bonds being issued.
More bonds means higher yields, usually.
Generally, yeah, more supply can mean lower prices for the bonds, which equates to a higher yield or interest rate.
And what's the current outlook for all those factors, pointing towards lower rates anytime soon?
Not really, based on the source materials analysis.
Oh.
The Fed seems pretty committed to keeping rates higher for longer to make sure inflation is truly beaten.
Okay.
The economy, while maybe weakening slightly, isn't showing signs of a deep recession yet. Inflation might even tick up a bit again.
And bond issuance.
With the debt ceiling likely being raised eventually, the government will probably need to issue a lot more 10-year bonds to fund itself.
So, putting all that together.
It suggests that long-term interest rates, and therefore mortgage rates, could continue to face upward pressure or at least stay elevated in the coming years.
And that's completely separate from the whole Fannie and Freddie privatization question.
Largely, yes. These are broader macroeconomic forces at play.
So it sounds like even if privatization takes a decade or more, we could still see some of the same effects on the housing market, like higher mortgage rates, maybe downward pressure on prices eventually, just because of these other economic factors?
Precisely. That's a key takeaway from the source. It even raises the possibility of that tricky short-term scenario we mentioned earlier.
The one where house prices stay high but mortgage rates go up.
Yeah, we've already been seeing some of that. It's quite possible that by the time privatization could realistically happen, years from now, some of the anticipated market adjustments might already be underway due to rising rates driven by these other factors.
That's a really important point. So maybe the main impact of actually privatizing Fannie and Freddie way down the line wouldn't be the initial shock, but something else.
The source kind of concludes along those lines. It suggests the primary long-term impact of privatization, if it happens, might actually be more about preventing a new housing bubble from forming later on.
By removing that artificial support.
Exactly, by letting market forces play a bigger role in setting rates and prices. unless, of course, some new form of government intervention comes along in the future.
It really brings it full circle, doesn't it? Thinking about why Fannie and Freddie were created in the first place, to help average people afford homes.
Right. And how they evolved got caught up in the 2008 crisis, leading to the government stepping back in.
And now this debate about letting them go private again. It really makes you wonder, doesn't it, about the fundamental sustainability of the whole system, the housing market, regardless of what happens with Fannie and Freddie specifically.
Absolutely. That's maybe the deeper question here. Privatization is one potential path, but the underlying challenges of housing affordability and financial stability remain complex.
Okay, so just to quickly recap for everyone listening, we've looked at the potential privatization of Fannie Mae and Freddie Mac,
Uh-huh.
highlighting that it's likely a pretty long and winding road, mainly due to the massive capital reserves they need to build up, probably years away.
Right. 5 to 15 years seemed like the plausible range.
But we've also seen that other big economic factors, things like the U.S. credit rating, Fed policy, inflation, bond yields, could have a really significant impact on mortgage rates and housing prices much sooner.
Yeah, those factors might actually drive similar market adjustments well before privatization even becomes feasible.
So it's definitely a complicated picture with lots of moving parts.
It really is. Understanding these different forces is pretty crucial if you're trying to figure out what might happen next in the housing market.
All right, so that's our deep dive into what's happening or might be happening with the mortgage market based on this article. Hope you found that helpful.
Hope so.
If you did and want to explore more topics like this, please do follow, like, and share the show. It really helps.
Yeah, absolutely.
And you can also keep up with more insights from What Bitcoin Taught Me on all the socials: Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.
Lots of places to connect.